Good morning. This is Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios, bringing you my weekly economic and market commentary for the week beginning Monday, October 14th, 2024. As a reminder, you can follow me or find me intra-week on LinkedIn, Herb Morgan, or on Twitter at Herb W. Morgan. This presentation has been prepared by us, Cantor Fitzgerald Investment Advisors, for use with both investors and financial advisors. Nothing contained in the presentation should be treated as investment advice, tax advice, or the recommendation for the purchase or sale of any securities. Everything is purely for informational purposes only. We had, yet again, another solid, strong week in equity prices, with most of the benchmark indices reaching all-time highs. S&P 500 up a little over 1%, now brings the year-to-date return to 23% as we've moved well into the fourth quarter now. Mid-cap stocks cut the bid as well last week, up more than 1%. Small-cap stocks lag behind. Still, they've had a pretty good year, 8.5%. International markets didn't participate quite as much, mostly on a little bit of a reversal, small, but a little bit of a reversal on that big China trade from the week before. Interest rates went higher as we continue to see more signs that the economy is a little stronger than expected. And there's some inflationary underpinnings that are in there and causing investors to believe that maybe inflation won't come down as fast or as much as the Fed and all of us would hope. And so interest rates ticked a little bit higher last week. You can see the aggregate bond index was down about 0.5%. In terms of economic data released last week, there was a fair amount. We also started earnings season slowly. This week coming will be the big week for earnings. But last week we heard that in August, consumer credit rose almost $9 billion, a little bit less than expected, not that big of a deal, because the prior month, July, was revised higher from 25.4 to 26.8 billion dollars. We also saw a large drop, actually the largest drop since 2021, in credit card balances, which is probably a good overall thing to not have the massive credit card balances on the U.S. consumer. We heard from the nation's small businesses. We also heard from consumers. I'll get to that a little bit later with Michigan sentiment. But the National Federation of Independent Business Small Business Optimism Index, 91.5. That's not a great number. Let me get my little laser pointer out here. You can see we were, north of 105 back here in 2018, 2019 into 2020. It's just been slowly deteriorating here. We started to get a little bit of a recovery and then not so much. So the small businesses, mostly it has to do, again, with inflationary concerns, cost concerns, cost of input concerns, and of course the cost of labor being one of the biggest. Also, now we're starting to hear more about uncertainty around tax and expense policy going out past 2025, as many of the provisions of the Tax Cut and Jobs Act of 2017 are set to expire. Staying on the business theme for a moment, wholesale inventories the month of August up 0.1%. The estimate was for 0.2. Not much to see here. That's just sort of a normal, healthy move. The inventory to sales ratio remains unchanged at 1.35. Perhaps the biggest data last week was probably CPI, PPI, coupled with the Fed minutes, the FOMC minutes from the September 17th and 18th meeting. This is the meeting where they decided to cut the federal funds rate by 50 basis points to stop the cycle of the hikes. We had been on pause for quite a while. And it was time to sort of untighten. They wouldn't call it loosening. They wouldn't call it loosening. But when we read through the minutes, we learned that the jumbo or 50 basis point rate cut was really not motivated by a deterioration in any of the labor data, but that their assessment of the risk in the inflation data was that it was coming down and there was very little risk of inflation accelerating. This is the part I think they made a policy mistake and got wrong. They also felt that the risks to the employment, which is the other part of their dual mandate, the risk to the employment component had gone up. So they wanted to be preemptive, get ahead of the game, and start that cutting cycle, and they took 50 basis points. Some of the participants, this was noted in the minutes, noted that the risk had changed prior to July meeting, and they had actually wanted the first cut in July of 25 basis points, and then September another 25 basis points. So in a sense, they made up for that. They combined those two 25 basis point cuts into the September meeting. But others said, no, we didn't want it in July, and we're ready to start now. We're ready to start with 25 basis points. And they would feel better with a more gradual normalization path. And almost all, so not all, there was one outlier, but almost all participants saw that the risks to inflation were to the downside. I would fall on, based on the data I'm seeing, I would fall with that outlier in this particular case, because I don't think the risks to inflation are continuing to come down. In fact, I think there's some very significant persistent risks that are there and that are not really being dealt with, the biggest of which is the fiscal deficit, the U.S. fiscal deficit, which is expected at 7% this year. That's a level not normally seen unless you're at war or trying to stimulate your way out of a major recession. So after the minutes came out the next day, but I'm sure the Fed had this data, obviously not for the meeting in September, but the next day this data came out, CPI and PPI data, next 2 days actually. Let's start with CPI, Consumer Price Index for September, expected to be up 0.1. It was up 0.2. Not good. Core, expected to be up 0.2, was up 0.3. That's in 1 month. You can compound that out. That's a very high rate of core inflation if it were to persist. When you look at the core CPI year over year, estimate was 3.2, came in at 3.3. Well, the Fed's target for core consumer inflation is 2%. Now, they use something called core PCE to measure it, but core PCE and CPI are going to track in a very similar manner over time. And seeing this sort of spike higher certainly doesn't lend to the argument that the inflation risks are waning. They're just not. Moving over to the producer price index side, PPI was flat. That's good. Core PPI up 0.2. Okay. Estimate in line with estimates. And then the year over year core PPI came in at 2.8. The estimate was for 2.6. So neither of these on a year over year basis are at the 2% level. So why did the Fed do it? Well, the Fed's going to say they did it because, as we stated earlier, they think the risks to inflation accelerating are low, the risks to job losses accelerating are high. Therefore, we want to be, 3 or 4 chess moves ahead of how the economy is developing. Okay, that is going to be the argument, but the risk to doing that, if they're wrong about the assessment on inflation, is that inflation could reaccelerate at an even greater pace. Now, then, on Thursday, we get the initial claims for unemployment. This is the weekly report we get, and all of a sudden, we see this spike. Initial claims for unemployment went to 258. The estimate was for 230. It was well higher than the week before. That's among the highest readings we've had in the last 3 years. But we also had people whose businesses were closed and jobs were lost because of the hurricane. Helene mostly hit Florida and North Carolina. That caused a lot of spike in initial claims for unemployment. We also saw about 9,500 spike in Michigan related to the auto industry. But this would be seen, obviously, a hurricane is seasonal and transitory. This is not, I wouldn't look at this and say, wow, jobless claims are rising and they're getting to the point where the Fed needs to take action. So not at all could this be interpreted in any other way other than directly related to the effects, the sad and unfortunate effects of the hurricane. Moving on to this week, we are getting into the meat of earnings season. We've got 44 companies reporting this week. Still a lot of the financials, Goldman Sachs, Morgan Stanley, you could see there Bank of America and American Express, but some good, Johnson & Johnson, good healthcare name, Procter & Gamble, good consumer name there. And then our first of the big techs will have Netflix report this week. So Monday, no economic data to report. New York State manufacturing and the budget for the federal government, the Treasury on Tuesday. Wednesday, import and export prices, weekly jobless claims. We're still seeing. I still expect that there'll be some effects from the hurricanes, and then obviously we now have the hurricane rolling through Florida. We've got retail sales, Philly Fed, industrial production, housing sentiment. None of these are expected to be particularly good. Housing starts and permits on Friday, and consumer sentiment, following up on the Michigan sentiment that we got last week. Thanks, everybody. This is available on my YouTube channel, Slaying Bulls and Bears, or on any podcast format. You can simply tell your smart device to play Herb Morgan's podcast or play Slaying Bulls and Bears. My goal here is to make the complex and complicated as simple and sensible as I can. Thanks, everybody, for tuning in. I'll be back to you again in 1 week.